Hey everybody, welcome to today's game plan on this Wednesday morning, just a couple minutes after 9 a.m. Don't forget, this stream is sponsored by Bybit. All right, we're going to get into some big stuff today. I've got a lot to discuss. I want you guys in focus. We have major data that's coming out later today from the Federal Reserve. We just got the PPI numbers earlier today, about 30 minutes ago, and we're looking at what the CPI data told us yesterday. So yesterday, let's start from the very basics. Yesterday, the CPI data came in at 4%. That's right in line with estimates. Now, we are in a market that is a melt-up market. What does that mean? Well, it means shorts are getting scared. The bulls are gaining traction. They're getting very virulent. They're feeling like they can't lose. And again, that is causing a melt-up in the markets. There was money on the sidelines that was kind of concerned about what the Fed was doing. Now we're hearing that today, likely we will see a pause from the Federal Reserve. Now, based on the Fed funds futures, that's exactly what we're expecting. So again, look for the Fed to pause today. Remember, that announcement comes out at 2 p.m. Eastern Time. 2:30 p.m. will be the point where Jerome Powell gives a press conference, all right? This press conference usually goes over things like questions from reporters, talks about any sort of glitches in the statement or any questions that people have. Now, the key is this. A lot of times the statement will come out, the markets will go one way. And then what will happen is the Federal Reserve, Jerome Powell, will look at that movement in the markets and say, okay, we didn't really want the markets to take our statement this way, so let me in my press conference say this instead, or walk back what we said a little bit and correct that move in the stock market. Now, I will say this. I personally don't believe that the Fed is happy with the major moves, the melt-ups in some stocks. If you look at NVIDIA, Apple, Microsoft, AMD, I mean, heck, you can go to Tesla. All of these stocks are making massive moves to the upside. So while the Fed is fighting inflation on one hand and wants to continue to bring inflation down, we have a melt up in the stock market while the crypto markets are being left for dead. And we'll talk about the crypto markets in just a minute. But the key here, again, is understanding that the Fed probably isn't happy, because what happens when the stock market goes up as much as it has, and the NASDAQ, for instance, is up something like 20% in the last 6 weeks. All right, when they see that, they realize the investors, the public, feel like they have more money. When they have more money, they're more likely to go buy a new dishwasher, a new car, a new oven, a new TV. And that creates additional demand. What do we know about when you have demand being stronger? The supply and demand curve, if you have demand higher, it's going to mean supply is less, which drives prices up. So the Fed in general wants asset prices to stay where they are or go a little bit lower. Now, they don't want the stock market to crash, right? That's not in their cards. But they don't want it to run back to all-time highs, because, again, that will create a hardship for the Fed to bring down inflation. All right, so let's get to the PPI numbers today. Remember, CPI yesterday stands for Consumer Price Index, so it's inflation on the consumer side. So right now we're looking at 4% on the consumer side. If you look at just core, which is food and energy, it's at 5.3%. So let's be fair. Core inflation is what affects Americans the most, right? The middle class, the lower income. Food and energy is a majority of what we spend money on, including rents. Rents can also be included in there as well. We know how crazy rents are. We know how crazy home prices are, especially with interest rates where they are. So the stuff that the average American spends money on continues to go up substantially, while everything else is calming down at a 4% inflation clip. Now, what this means, guys, and I want to be crystal clear on this, it doesn't mean prices are going down. It means prices are going up less. So they're still going up. So we're still at 4% overall and 5.3% on food and energy. And that means that every year you're paying 4 to 5.3% more for everything. So it's going to cost you more, just the nature of it. Unless we get inflation to go to zero, prices are always going to go up. Now, one of the reasons why, and my thesis has been for a long, long time, and we'll get to the PPI data in just a minute, but my thesis has been that bringing inflation from 9 to 5 or 4 or even down to 3 is relatively easy. What's not easy is getting it from, let's say, 3.5 to 2% where the Fed wants it. And my guess is, and you can quote me on this, you can save this clip, is that we will get in a scenario where they get inflation to, let's say, 3% and it becomes sticky. And the economy starts to trigger a recession. and the recession starts to get worse and worse and worse. And ultimately, what you'll end up seeing is that the Fed will say, oh, well, we now have 7% unemployment, 3% inflation. Which one's the worst scenario here? Is 3% inflation bad, or is 7% unemployment, or 10% unemployment bad? And they'll say, okay, well, we have to lower interest rates. Even if it's going to create a little bit more inflation, we have to lower interest rates because, again, unemployment gets so out of control, a recession turns into something that's even worse, a bad recession. I'm not going to use the word depression because, again, I don't think we're there at that point. I think that's later this decade with the 100-year cycle, but I do think that that's on the horizon. All right, so PPI data this morning coming in, it fell 0.03% or 0.3% in May, the third drop in the past 4 months. The markets had expected a decline of 0.1, so better PPI data. Now, interestingly enough, if we go to our charts, the charts are actually showing us that the markets are not reacting to this decent PPI data. And you might say, well, why? Well, the answer is very simple. The PPI data is old news already. Everyone's focusing on later this day, 2 p.m. when the Fed is going to make their decision and give their comments. So the market is kind of a little wary here. We've had these crazy melt-ups. The NASDAQ 100, we can clearly see here, had a big day yesterday. In fact, it looks like we're now negative by just a hair on the NASDAQ 100. And again, it's had such a massive move up that we're now at a point where the Fed has to deliver something dovish. They have to deliver. If they don't hike, which is what's expected, that's already built in, them not hiking, them pausing. But the question is, what are they going to say? Now, the Fed funds futures actually show rate hikes later this year, the market is expecting. So the market's expecting rate hikes to go up later this year, yet asset prices have gained so much value just based on the hope of money flowing into the markets from investors that are hoping for a pause and a loosening scenario. So there's this disconnect, right? There's this massive disconnect between what equity prices are telling us and what interest rates are telling us. And investors, smart investors, need to be paying attention to this. Now, I want to show you this. So if we go to the Dow Jones Industrial Average, let's go back to the Great Depression, right? I want to go back to this chart here. Let me actually go to the Dow Jones on the charts because I think that's important. So what we want to do is, I always look at history, by the way. History is the greatest indicator of what likely is to happen. So we're going to go all the way back to the Great Depression, which with the Dow, that's really the only information you're going to have, right? All right, so in the Great Depression, we see that when it first started, what ended up happening? We had a big initial drop. And what I'm going to do is I'm going to draw trend lines here. We're going to draw a measured price range. So we're going to take the high to the low. Okay, so we dropped about 49% in that initial drop. You then saw another up move here, and let's bring that right back up here. We saw a bounce in that market in the Great Depression of 51%. So basically equal, right? 49 to 50%, 50, 51% bounce. All right, so again, my point to bring this to your attention is that if you look at what the NASDAQ has bounced, or the S&P has bounced, or the Dow has bounced from our initial down move, these type of bounces, right? We're not up yet equal, right? And I want to make that clear. And I'm going to show you guys on the NASDAQ. In fact, let's go to this chart right here and bring up the NASDAQ. We'll look at Ethereum in just a minute here. But I want to actually go to the NASDAQ chart. Okay, and this is a really big, important part here. So what we can see here is if we go to our weekly chart on the NASDAQ, okay, in fact, we'll go back to the daily. We can look at it on the daily chart. We'll just zoom out a little bit. Okay, so here is your drop. And I'm just going to zoom out a little bit more so we can get the whole picture in. All right, so if we go to our price range and we take the highest point here to the lowest point down here, which was this point right here on the chart, that's a 37.5% drop. Now, if we also take that same low and we go to where we currently are, how much of a bounce do we have? We have about a 35% bounce. So 37 down, 35 to the upside. That, by the way, that potentially leaves us open for about a 2% more move to equal the down move. Now, the reason why I'm drawing this comparison is that there is this narrative that's being spun that a lot of you guys are falling into. And again, you could go back to 2007, you go back to 1999, the dot-com bubble. This is what happens to markets. They lure you in. The bears initially get the big drop, and then at the end of the drop, everyone else panics. Think about October of 2022. Everyone panicking. Think about in 1929, you had the stock market crash, everyone panicked. Then you got the mega bounce, 50% bounce, folks. 50% bounce in the Great Depression off of the collapse in 29. Then the markets continued down more and more and more. You go here, you can see that same sort of thing playing out. And this is so psychological. It's human nature. And I try to express this to you guys so many times. That's why we have a peak performance coach here that knows and understands the brain. And by the way, she has an amazing show, Verified Mindset, that you guys have to check out on the Verified Investing YouTube. So make sure to follow Verified Investing YouTube right there. But the point here is that you have the psychological nature of people wanting to believe after a big drop that the markets will go right back up, right? They're stuck in positions. They bought some of these stocks at 52. I mean, think about Roku, right? I mean, look at a stock like Roku. If we go to this chart, and you can see, I mean, we've been analyzing it all the way down here, but this stock was a $500 stock. It is now a $73 stock. Look at SE, all right? SE, this was a $375 stock. It's now a $65 stock. Now, granted, large cap tech, they're in a league of its own, right? I mean, large cap tech, a lot of them are near their 52-week or all-time highs. But if you look at a majority of the other stocks, and this is key, if you look at the S&P minus those top 10 stocks, if you look at the S&P minus or the NASDAQ minus the top 5 or 6 big trillion-dollar companies, as well as pull out anything that's been mentioning AI. And that's key, guys. You have an AI narrative right now that is driving anything that mentions AI. Just like, by the way, 2017, you know what the hottest thing was to bring forward? If you wanted to make your company go up, all you had to mention was blockchain. Riot blockchain, I still remember the run that had back then. If you go back even further, mention marijuana. That was the hottest thing out there. You go back further, 3D printing, solar back when it first was big and first solar first debuted. In fact, I want to show you this chart because it is remarkable. So let's go to the monthly chart of First Solar. All right, when First Solar debuted, solar was the hottest thing out there. It went from $20 to $320. Then you know what happened? It collapsed back to $10. Okay? Now, I'm not saying that AI is not useful. AI is going to be a huge part of our future, but it is a narrative that people have attacked and started to run with and think that it will be unlimited and pay out huge dividends in a short amount of time. The way we know from past bubbles is that it's a longer process. There will be winners, there will be losers. And overall, First Solar is a big winner, right? I mean, look at the stock now. It's all the way back to $200 a share. But it takes time. And investors, again, don't think about that. Timing is the hardest thing to do. So what people do is they FOMO in. Think about altcoins, right, prior to the latest collapse. FOMOing in, all of that stuff. All right, guys, I'm going to quickly get over here to crypto. I know everyone wants to know on crypto. So if we go to crypto, here's your Bitcoin chart. Bitcoin continues to hold my key support level here of around 25,700. This is still bearish consolidation. I still expect more downside. Target remains, and I've said this now for multiple weeks, you're looking at major support at 24,000. Now, the narrative here with crypto is nasty right now, and you can see it. I mean, this is the market where crypto should be ripping. When you see Nvidia going up every day, when you see Tesla going up every day, think about 2021. Those were the stocks that were leading the charge there, but you had altcoins going up insane. You had Bitcoin, you had Ethereum running up, and they're doing nothing. All right, why is this? Thank you, SEC. Thank you, Gary Gensler. You have put the cap here based on so many uncertainties, whether it's with Binance and what the heck's going on there, who knows even what's going on there, filing lawsuits against Coinbase and everything like that, and basically not giving any clarity. Now, again, where is Bitcoin going? Well, one of the things we can see is that Bitcoin has done virtually the same thing that the 1929 market did with the collapse. This market in the NASDAQ has done, which every market has done, guys. So again, to see a bounce like this is not unusual, right? When you see a decline of this magnitude, you're going to get a technical bounce. Everyone at 30,500 was like, this is a new bull market. Crypto to the moon, crypto to a million, whatever it is. Alt season was going to come. I mean, I'm still waiting for the alt season. I think most of us out there are. But the point again here is that you have to understand the way markets work is all based on this. When you look at millions of investors and psychologically, are they greedy? Are they FOMOing in? Are they fearful? Are they panicking? Right? Panic doesn't denote the beginning of a sell-off, it denotes the end. Think about FTX. When FTX came out and that collapse occurred, that was the end of that initial down move before the bounce. That was max fear. We're now getting into the beginnings, in my opinion, of the next wave. I don't think we're at max fear yet. I think you're still going to see more actions by the SEC, so there's probably more downside to go. Now, will Bitcoin take out the lows? I don't know. We're going to find out. I'm still in the camp that it could. All right, if you look at the dot-com market, and again, dot-com market's so similar to what happened in crypto. Brand new technology will change the world. Dot-com was the internet. Brand new technology will change the world and did. I think Bitcoin and crypto will change the world and is changing the world. It's just going through growing pains. So these are the types of things that I look at as a trader. I don't look at things in a FOMOing greed or fear mentality. I analyze that and I analyze other people's emotion because it gives me an edge. I say, people are getting way too scared here. Let me go to the charts and start looking for technical support. Or at 30,500, wait a minute. The amount of greed that's in crypto right now is as robust as we were when we were at 69,000. If that denoted a top at 69,000 on Bitcoin, then it probably also can mirror a top here. And what happens? Bitcoin comes back in. It was also a major technical level as seen in the chart right here. So these are the things that, again, as a good trader, as an investor, you have to start paying attention to. All right, if you're someone who's looking at Twitter for information, if you're someone who's following, the latest influencers, you're going to lose money. It's guaranteed. I will guarantee it. Now, a couple times you'll make money because that's just the nature of it, but over the long term, you will lose. You need to learn charts and you need to learn human psychology. So again, guys, so important. And listen, to learn human psychology and trading, to learn charts, I want you guys following the Verified Investing YouTube. So much content is going out on there now. We have multiple traders posting videos. Jess, Mindset Peak Performance Coach, is doing research and continually adding content there. I'm doing a show with Ben Cohen now. This was an amazing show. You guys, if you're not watching that show, the amount of data that we pulled out, it's called the no-shill zone for a reason. The no-shill zone, because it is data-based, there's no emotion, and it is right to the point. So make sure you're following Verified Investing, guys, on YouTube, on Twitter. Follow me, obviously, as well. And I'm going to wish you guys the best of Wednesdays. I will let you know what I think of the Fed later today once they come out. Let's see what the market does. I wish you all the best. Now go make some money, guys. Make smart decisions based on logic and data. Have a great one. Thank you so much.